Reconciliation of cost and financial accounts. Need for reconciliation. The financial and the cost account cost is in the same organization. They deal with the same basic transactions, but the difference of purpose call for a difference in approach in collection, analysis, and presentation of data. Financial accounts are concerned with the ascertainment of profit or loss for the whole operation of the organization for a relatively longer period, usually a year, without being too much concerned with the cost of computation. Whereas the cost accounts are provided for ascertaining the profit or loss made by a manufacturing or a products for the cost comparison and the preparation and use of a variety of cost statements. The difference in purpose and approach, more often than not, result in different profit from what is disclosed by financial accounts, and this established the need for a reconciliation of profit between cost accounts and financial accounts. Reconciliation is necessary due to the following reason. One, it finds out the reason for differences in the profit or loss in cost and financial account. It ensures mathematical accuracy, reliability of cost accounts in order to have a cost ascertainment, cost control, and to have a check on financial accounts. It contributes to standardization of policies regarding stock valuation and depreciation and overheads. It facilitates more coordinations and promotes better cooperation between activities of financial and cost section of the accounting department. Reconciliation places management in a better position to implement more effective cost control. Causes of differences. The 6 reasons. Items shown only in financial statement. Items included in cost accounts only. Over and under absorption of overhead. Adoption of different basis of valuation of stock. Different method of charging depreciation. Abnormal gain and losses. The first cause of difference is item shown only in financial item. Then there are three. First one is purely financial charges. Examples: loss of sales, loss in sale of fixed assets, loss of investment, discount issue of shares, interest, expense of companies, transfer of damage, penalties, loss or scrapping of business. The second point for items shown only in financials is purely a financial income. Rent receivable, interest received, profit made on sale of investment, transfer of fees, interest, dividend received, brokerage fee received, discount, etc. Third point, items shown in financial only is appropriation of profit. Examples: donation and charities paid, tax on income, profits, dividend paid, transfer to reserve fund, reserves and sinking fund, additional provision for depreciation balance, amounts returned of capital expenditure charged to P&L. These are the three. First, the causes of difference. Second one is item included in cost accounts only. These are the things. The interest on capital, notional interest on capital on production, interest on capital employed. Charge in lieu of interest, charge in lieu of rent in where the premises are owned, depreciation on asset when the book value of asset is reduced with a negligible value, the salary of the proprietor where he works but does not charge salary in finance book. These are the second cause. The items shown only in cost accounts: notional interest, rent, depreciation of asset after the useful life, salary of proprietor. Then under the third reason cause for differences is under or over absorption of overhead. In cost account, no recovery of overhead is based on estimate or predetermined ratio. For percent example, percentage of prime cost, percentage of sale, which may be more or less than the actual amount incurred. In financial account, actual expenses of overhead are recorded. If overhead are not fully absorbed, the amount in cost account is less than the actual amount. The shortfall is called under absorption. On the other hand, if overhead expenses in the cost account are more than the actual, it is called over absorption. Those over and under absorptions leads to difference in two books. The under recovery or over recovery of overheads may be carried forward to the next period, or maybe charged to by supplementary rate, or charged to profit and cost, or maybe charged to cost and profit and supplement. So option is there. In case under recovery or over recovery over has been carried forward to the next period, the profit as shown by the cost account will be different from the profit as shown by the financial books. Then adjustments will have to be made. It's a must. The third cause of difference is adoption of different basis valuation of stock. Raw material, work in progress, and finished goods. Financial account, raw material stock is material is valued at cost or market price, which is less. In cost account, stock is valued on the basis of FIFO, LIFO, or any other basis. The method is based on that method. So there is a difference. There may be a chance of difference in inventory valuation. Work in progress. Another valuation of work in progress may also differ. It may be valued at prime cost or factory cost or cost of production. The appropriate method of valuing is at factory cost and cost accounts. The financial accounts work in progress may be valued after considering the part of administrative expense also. And then the change in financial goods. Financial accounts, the stock of finished goods is valued at cost or market price, which is lower. In cost account, finished goods are generally valued at the cost of production. Method of valuation definitely give rise. The difference in method of valuation definitely give rise to a different result in two set of books. Fifth cause of differences is method of charging depreciation differ. In finance, method of depreciation is totally governed by Companies Act or provisions of income tax. Normally, definition method or statement method is followed. In cost account, machine hour rate, production hour rate, or unit cost method is used for charging depreciation. So, fifth one is abnormal gain or losses. Abnormal gain or losses may be completely excluded from the cost account, or may be charged, or may be taken to costing profit loss account. If it is excluded, costing profit will differ from financial profit. Adjustments will be required. If it consider in case if these are transferred to costing profit loss account or profit or loss shown by, then profit or loss shown by the cost account will agree with the profit or loss of financial accounts. In such a case, no adjustment will be required. Example: these are the example abnormal various losses is as an example of losses. Then how to prepare the reconciliation statement? Normal reconciliation statement or memorandum reconciliation account. Then reconciliation, how to prepare a reconciliation statement. There is a difference between the profit. If there is a difference between profit disclosed by the cost account and financial account, and the following steps shall be followed to prepare a reconciliation statement. First, ascertain the various reasons of disagreement between two set of books. If profit as per cost account or loss as per financial statement is taken as a base, then add the following. Next is Deduct the following if profit or loss as per cost profit as per cost account or loss as per finance statement is taken as a base. Starting deduct all these things if you have taken that as base. Next is reconciliation in short. First ascertain various reasons of disagreement. Then if profit as per cost account or loss as per financial is taken as a base, then deduct and add and deduct item listed above. Then after making this addition and deduction, the resultant figure will be exactly equal to profit as per financial statement. Here is important thing is the base for calculation, starting for base taken as a starting point. If profit as per finances account or loss as per cost account is taken as a base, then item added above shall be deducted. Then items to be deducted shall be added. Reverse the procedure. Then next is the memorandum reconciliation account. The same result will we will get the same result we will get the same answer, but the presentation is in T form. This is a specimen form of memorandum reconciliation account. Okay. Debit these items, credit this, then we'll return. This is an example. This is the illustration. Company financial profit 36,450, cost profit 51. Then adjustment is there. Opening stock, closing stock, variation, factory overhead, administration, selling, depreciation overstated, interest on investment, citizen loss, and tax, bank interest. This example is there. Solution first. Reconciliation statement. Start with the profit as per financial statement 36,000. Then add this addition because of the base we started as a profit as per financial statement. Then add back many items to reach the costing profit amount. That is add item are not debited, add under recovery of factory, add under recovery of selling and administration cost account. Total 32,350. Then less item not credited, less over recovery of administrative expense, less over recovery of depreciation, less difference in stock. Opening stock overstated, closing stock understated. Okay, we got 16,000. Finally, costing amount we reach the profit as per cost account we reach. The same thing we can prepare it using memorandum reconciliation account. It is a debit credit account. This is a format debit side. This is a credit side. So here also credit side starting point profit. Profit we started as a credit point. Then I credited whatever item added. Debit side whatever item to be deducted before. Then net balancing figure will be profit as per cost account. This is the summary of reconciliation, need for reconciliation, causes of differences, and how to reconcile it, and the two reconciliation statement. That's a reconciliation statement, normal one, or memorandum reconciliation account. Thank you very much.